Good morning, everybody. This is the live market open for December 17th. It's Thursday, and it's the day after the Fed. We had the historic rate decision. Big day for markets. Well, it was well delivered, so we didn't have extreme moves. Anyway, we'll talk a lot about that and, of course, other stuff. I'm Yohay Elam of Forex Sequential Market Movers podcast, doing the show as usual for FX Street. Of course, we'll cover recent developments, the Fed, and a few other things, charts and levels, the next 24 hours, and of course, your questions about the Fed or anything else. If you cannot see the chat box on the screen, please go to tlk.io/fxstreet-forex-live-video, and looking forward to see you all with your questions. Okay, so what did we have yesterday? We had the historic rate hike. Okay, some didn't believe that we'll actually reach this moment because the first rate hike after nearly 10 years, the last one was in early 2006, and the first change in rates since 2009, early 2009. So it's a big day, but it was well telegraphed. Okay, that means that, as Yellen said, it was not unanticipated. Okay, nice understatement. That means that she did prepare markets, well, her colleagues as well, of course, during a very long time, including what she said 2 weeks ago, that delaying the liftoff would have risks. Okay, so we've seen, of course, the choppy reactions, but it was all in all well received. That means that, let's look at the charts just a bit. Okay, this is euro dollar. Look at what happened during the rate hike. Yes, we've seen these moves up and down, but it's nothing in compared to what we had from Draghi just 2 weeks before. Okay, that means, look, here's the Draghi rise, and then we saw more rise. Now we're seeing some kind of slide in the range. Okay, a stronger dollar will explain that, but all in all, not crazy. If you look at stock markets, we had stock markets in the United States closing higher yesterday. So it was a great success in that term. Also, if we look at the fact that there were no dissenters, okay, we had the unanimous vote, 10 people voting for a rate hike, all the voting members. That's also a sign that it was sort of well prepared. Now let's look at what did move markets. First of all, the dot plot I was talking about a lot yesterday. This is this chart that shows what the median forecast is. So basically, there was no change. This was relatively hawkish. Why? Because in previous forecasts, previous dot plots, we had this figure drop from sort of lower expectations, less rate hikes, more gradual, including for next year, which is of course important because it's right around the corner, 2016, and also for next year. So we had no change for 2016. It remained at 1.4%. It means that according to this dot plot, which is not a commitment, it's just the median of Fed forecasts, we're expecting no less than 4 rate hikes next year, a full 1% raise from the current range of 0.25 to 0.5. Okay, that's the actual rate hike, to up to 1.5%. I don't think this will actually happen, all this, but the fact that the dot plot was not lowered, that we didn't get this sweetener, we didn't get this smoothing, is telling. And I think it's hawkish. Now, we did have a lower rate for 2017, 2.4 instead of 2.6, but like 2016, also the final rate was not changed, so we had 3.5%. Okay, so this was the most positive thing for the dollar. Let's look at a bit at charts before we talk about other developments in the press conference and elsewhere. So this is euro dollar. As we've seen, it dropped initially, then went up. We've seen it in all the charts. Okay, so first of all, the immediate reaction, I think, to the dot plot and to the fact that we did have a hike. We've seen a stronger US dollar across the board. Then we've seen a weaker US dollar, so we've seen euro dollar even rise above 110. It was sort of 15 minutes in and during the press conference. And then during the Asian session, as we said, we always have a second reaction, a third reaction. Now I think we're seeing a more significant reaction because there's much higher liquidity in the European session. Anyway, we've seen markets understand that the hike is a hike, and stronger dollar, less dovish than expected. Okay, for euro dollar, I'm looking at 108.30. We talked about this line in the past because I think it was a good separator of ranges despite a very short breach last week. Okay, so this is the line I'm talking about. 108.30 is support, followed by 107.60 and 106.30. On the top side, we still have 109. I would say 109.50 and 110, of course, the round number, followed by 110.70. Similar reactions were seen across the board, mostly on majors more than commodity currencies. We'll soon explain why. So pound dollar also deteriorated. It had its own reasons to fall, but it kept deteriorating. It did move the same way. A slight move to the upside and then, to the downside, then to the upside, and then the full reaction to the downside. Now dipping below support at 149.40. Next support 149 and 148. Resistance at 150. Okay, dollar yen. We talked about 122.20, and I was yesterday on broadcast with Valeria, Dale, and Mauricio, and Valeria also emphasized the importance of this line. So we're currently at 122.40. We went a bit higher even. I think we have a breakout. I think we have a settling above this line once again. Why is this line important? If we just zoom out a bit, then we can see that 122.20 was the bottom of the range, of the high range, then worked very nicely right here, actually last week, I think, as resistance. And now I think this resistance has been breached and we're back to higher levels. Let's see if it's sustained, because often with these kind of moves on big events like like a rate hike last time it was seen a decade ago, and with relatively low liquidity towards Christmas, it might be a false break, but the dollar yen has been quite reliable of late. Dollar CAD, okay, they're very similar immediate reaction. In general, a weaker Canadian dollar. As I said, the sky's the limit. Oil prices are falling. We're at the 35 handle today. Yesterday we had we had a rise in inventories, so it was also weakened the price of oil. But in general, stronger US dollar is felt also here. Aussie dollar, amazing technical behavior. Look at the 72.80 line. So we had a stronger US dollar, then a weaker one. The weaker US dollar sent Aussie to 72.80, and from there we had another fall and found support just above 71.50, maybe 71.60 is more correct. But all in all, very nice range trading and a weaker Australian dollar. So because we have a stronger US dollar. Standing relatively strong is the Kiwi, holding above 67 very nicely. It made a small sort of move above 68. I see 67.90 still as resistance, albeit with weaker. 69 is much stronger resistance. Support is at 67 and 66. Okay, so this is what we had in terms of currencies. Let's take a look at see if you have any questions before we explain a bit more. So good morning, everybody. Good morning, Fabian. Good morning, Pan. Good morning, Jax. Good morning, Ken. First time here, you're welcome. Setup is strange. It's short. Chat box is below the video, so I can't see. Okay, I'm glad, Mauricio. Thanks for helping out. Same video with the chat. Can you look at gold, please, after currencies? Yes, I'll take a look also at that. Great page watching. Great, thanks. Okay, better for you. Yeah, all the shows are broadcasted here. Yeah, we have 3 daily shows and many weekly and monthly webinars. Yesterday we had a special release. So yeah, and this is the chat box. We use one chat box to rule them all. Oh, that's from Lord of the Rings, not from Star Trek. Star Wars, sorry. Oh, confusing everything. Anyway, looking forward to your questions. Yeah, good morning, everybody. We'll cover gold. Let me just finish what we had yesterday regarding the Fed. Okay, so yeah, so here at Kiwi Dollar, let's look. I want to complete what we said about the Fed. So historic rate hike, no change in the final rate for 2016, 1.4. Slightly higher forecast for growth. That means we have now 2.4 instead of 2.3, so that's relatively hawkish, and slightly lower for inflation. Inflation is relatively weak, and also we had some special focus on inflation in the statement. Okay, so we had in the statement we had a specific paragraph on on inflation. That means where the Fed acknowledges that it misses the inflation target, and we heard it also in the press conference. The Fed wants 2%. We have it lower because of oil. The Fed still sees that as transitory despite the fresh fall in oil prices, not only the fall from last year but another fall. And also a stronger dollar is feeding into core inflation, but also this, the Fed sees that as transitory. But it put in the statement big focus, that was the sort of dovish sweetener, that it will keep a close eye on inflation. The next moves depend a lot more on inflation because employment is we're close to full employment, okay? So we had to focus on inflation. That's the dovish side. That's perhaps what caused the slide in the dollar, temporary slide. We had a rise in the dollar, a drop in the dollar, and then a fresh rise in the dollar, which is much stronger, felt in a very strong manner. So we had to focus on inflation over there, okay? And we had also in the press conference, let's put my slide back on. Just want to emphasize inflation. So in the press conference, Yellen had she was asked why. Why did you raise rates if inflation is so low, and why in general did you raise rates? So the best answer she gave was, we don't want to have to raise rates abruptly. We don't have to allow the economy to heat up for bubbles to emerge and then try to slow it down a bit in a strong manner, a bit abruptly, raise rates very quickly, and cause a recession, the fear of recession. In addition, the fear of recession is behind the decision to move rates now. So in case we have recession, the Fed has tools. Now, this argument I don't find it that strong, but anyway, I think the Fed fears bubbles more than anything else, and that's why they moved. Okay, they said that low inflation is transitory. Okay, I mentioned that. And for the Fed to move once again, they don't need to see inflation reach 2%. She mentioned there's no mechanical manner. Graduality doesn't mean raising rates every second meeting. No automatic thing, no formula. She repeated that, no formula. They have to see a wide range of things, employment, inflation, mostly inflation, move in the right direction, have forecasts rise in the right, move in the right direction in order to move. Okay, so it's that's where we're going. In general, she made it clear that monetary policy is still loose, the accommodative, the balance sheet of the Fed that is bloated thanks to QE. Now we don't have new QE, but they maintain a 4.5 trillion dollar balance sheet. That's going to stay for some time until they see fit. And this and what else did she say? Yeah, in general, she talked a lot about confidence. They have confidence in the US economy. That's another reason to raise rates. They think the economy can withstand this rate hike and further ones, all in due time. She was asked about about junk bonds, and there was one specific case of Third Avenue, and she said she sort of dismissed it, said it was a special case, a special company. She doesn't see too many worries. I think that they want to have these kind of bankruptcies, these kinds of redemption problems only on the sidelines. Better weed out the problematic ones now than have all the system explode. Okay. Anyway, it was in general well received. Let's answer the question about gold before moving to other developments and other things. Gold chart, I must say, don't follow gold that closely, but why can't I see it here? Sorry, I'm unable to get that chart for you at the moment. But let's try again. Ah, yeah, here I have it. Yeah, gold at 1066. Very choppy on the 240-minute chart. I don't see it going anywhere fast. On one hand, we have industrial demand, jewelry demand. On the other hand, well, there's much less speculation than there used to be, because as hedge against inflation, we already know that it doesn't really exist, it doesn't really work. Still, it's keeping a safe distance from 3 digits from the round number of 1000, but in general, it's quite depressed in the daily chart. I see some resistance at 1090, I would say. Well, this range between 1090 and 1100, and support at 1050. I think it'll continue wobbling in this area. We are seeing it drop just a bit at the moment, but nothing really significant. In general, a rate hike in the United States is bad for gold, because you can keep your money in US dollars, receiving interest. Up to now, it was very close to zero, and there's less demand for gold, which has no yield. Okay, so the impact for gold, I believe, will be negative. Okay, to answer that question. I think we had more questions I wanted to answer and talk about other stuff as well. Good morning. So stocks were happy with the decision, right? Says Mauricio. What Yellen said in the conference that made stocks go higher? No hike in 2016. The market's ready for hike. I think the answer is mostly that we had a great preparation. Okay, so as she said, it was not unanticipated, the understatement of the year. They talked about raising rates for a year or so. They talked about patience, a considerable amount of time. Then they removed it. And in September, they thought of doing it, but like with the taper tantrum, they decided to wait longer. And in October, they told us, towards the next meeting, we're going to consider these and these factors. After the non-farm payrolls came out better than expected, she said also the length liftoff has risks. All the other Fed members also talked about historic decision. Markets were prepared for months and months. Regarding the technical stuff, they were also prepared. Okay. In addition, we did see stocks slide in the few days before the decision, so now they also rebounded. And no, I do think they'll raise rates in 2016. The dot plot implies 4 rates. I think we'll have 2 or 3, but it's all, of course, data dependent. And I think she did manage to send a message of confidence. Confidence in showing that in showing that the economy is doing well. Confidence in that the Fed made a decision without dissenters. In general, it was very balanced and good. She had a good public appearance as well. Okay. Another question here. Who will be next to react to the hike and how soon? The Bank of Japan meets on Friday. Yeah, Friday is just around the corner. Okay. So it's just actually less than 24 hours from now. I don't think the Bank of Japan will react. I think we talked about this earlier this week, because the Bank of Japan has less reasons to provide loose monetary policy. Okay, the Bank of Japan is seeing better growth than expected. Japan is actually not in a recession. In the past, we had fear that Japan is in some kind of recession, and this is not the case anymore, according to the revised data. Also, according to some measures of inflation in Japan, we're not seeing any. Well, according to the Bank of Japan's measures, inflation is picking up. You have to really take specific statistics and not others, but in general, the situation is not doesn't require action. Of course, they don't want a strong. They don't want a strong yen, and I think the Fed is doing some of the job for them. So the next move from the Bank of Japan could be loosening, but there's no urge. They had an opportunity to act in October, and they didn't do that. Okay. So and perhaps there's just no need. Okay, we have more questions. Pence says, would you say dollar CAD has more pips to the upside than oil to the downside, or is CAD yen more correlated? I would say that dollar CAD has more pips to the upside than oil, because it's not only oil, it's also what the Bank of Canada said, that we've not reached the lower bound. Okay, currently the interest rate in Canada is 0.5, and they said the lower bound is minus 0.5, not 0, which is of course a very balanced number, and not 0.25, which was the low after the financial crisis. So dollar CAD vs CAD yen. Perhaps CAD yen is more correlated because it's sort of the risk sentiment. Yen is more of a safe haven, and then if we have times of trouble in markets, weak oil prices, the Canadian dollar falls, and then the yen strengthens more than the US dollar. But with this rate hike and the sort of bullish wind that the dollar gets now, I'm not sure that will be the case. We'll have to see how the correlations reemerge. Remember, when we have big decisions, we have also changes in correlations. Another question, I have an issue. I'm not sure traders have too. My broker server time differs, so candle patterns will differ at times. Don't know which pattern holds true for trading. There's some change about the Fed funds rate and discount I don't understand fully. I'm not sure what effect this might have. Lehman's was a special case too. Yeah, so regarding candle patterns, well, if you choose the hourly charts or 4-hour charts, well, if you choose the hourly ones, well, an hour is an hour all across the world. It's not daily, and it's not a 4-hour frame if you really want something very global. But I don't know, you should just get used to the candles. I mean, use a set of charts, get used to them, see how it works for you. And yeah, you can get confused by charts from other platforms. Regarding the discount rates and things like that, it's not that important. The big deal is the federal funds rate. That's the big change. We haven't seen this change for a long time. There were fears about implementation. I think there are too many fears over there, and the Fed is working on this for 2 years with all kinds of experiments of repurchasing. We'll get the full answer, first of all, today with the implementation during the early hours of the United States session. The first thing to watch is that if I'm not mistaken, 12:45 GMT, and the full answer will get it by the weekend. I think it'll be smooth, and that perhaps could give the dollar another boost. So it's 12:45 GMT today for the first thing. You can also follow the Fed funds rate by the New York Fed, what the effective rate is. Okay, so it used to be around 0.12, 0.13, which is between 0 and 0.25, and now it's expected to rise to around 37 basis points because it's between 0.25 to 0.5. So, of course, there are fears about implementation. They haven't raised rates for nearly a decade, and the world has changed quite a lot since then. For instance, if any of you is using the iPhone was introduced only in 2007, after and the previous rate hike was in 2006. Anyway, so of course there are some fears. I think the Fed is well prepared, and I think they'll pull it out quite well. They sent a really good message of confidence. 12:45 GMT is the first test, and by tomorrow afternoon we'll know if markets are functioning well or not. But it's better just to look not only at the implementation, but how stock markets react and see the so far stability. If this continues, I think they pulled it out quite well. Okay, another question. That demand is tiny, isn't it? Jewelry industrial? Yeah, but it's the real world demand. And beforehand, we had speculation pushing gold higher. Okay, close to $2,000 because it was a sort of hedge against inflation or something like that. And it didn't work out because inflation is really low. So all the gold bugs disappeared. So now it's just more basic supply and demand and limited speculation, not crazy one. Question here. Now with the Fed hike, do we see a euro-dollar carry trade evolving? I'm not sure it's much of a carry trade because the difference in rates isn't big, but in general, the monetary policy divergence, the fact that the Fed is expected to continue raising rates and the ECB could still introduce more tools, I think that could push euro-dollar a bit lower. Okay, when I saw yesterday this rebound in euro-dollar, I said it doesn't make sense. because the rate, first of all, we had a rate hike. Secondly, it wasn't that dovish. Okay, we have 4 rate hikes on the cards. Okay. A question: what wasn't everybody waiting for the Fed hike before they moved to? Yeah. The Fed hike was anticipated. The ECB acted before the Fed, so of course they were waiting to hear from Janet Yellen. Some suspect that the ECB didn't move too much because they were waiting for this rate hike to do the job for them, or part of the job. I think the ECB just had internal conflicts, and Draghi created expectations that were too big. He did some damage control since then. Well, tried to do, didn't really work out for him. But anyway, yeah, yeah, that's what's going on. Sold gold at 1710. Wow, thank God. Yeah, that's quite a gap, no? Okay. All right. Let's talk about other things we have in the market except the Fed. Well, is there anything else? Yes, there is. Let's talk about that. Okay. So yesterday, what we had in the market, UK wages coming out worse than expected. Actually, providing a vindication for the Bank of England, saying that wage rises have flattened a bit. It was 2.4 instead of 2.5 expected, and excluding bonuses was also disappointing. At least the unemployment rate continues falling in the UK to 5.2%, so that's good news. But we found a relatively vulnerable British pound. Okay, in the eurozone, inflation, headline inflation, was revised up from 0.1 to 0.2, but core inflation remained unchanged at 0.9. It was this was data for November. We'll soon have figures for December, or soon in 2 weeks or so. Housing data in the UK. Both figures came out better than expected, both building permits and housing starts. Good news. Didn't really have an impact on markets because it was Fed day, but once the dust settles, it's good news. On the other hand, industrial output missed expectations in general. Manufacturing in the United States is certainly a weak link because of the strong dollar. Because the United States, like other countries, is still undergoing this deindustrialization, moving more and more and more into services. It's not a new phenomenon, but we're really seeing a weaker link over there. Talked beforehand about a big rise in oil inventories, and this resulted in weaker oil prices and a more vulnerable Canadian dollar. Okay, today we have quite a few things on the agenda. German IFO figure at 9 GMT, just after the show, in 30 minutes time. IFO is, or IFO, is Germany's #1 think tank. Okay, Eurodollar during the show is making, no, well, finding support at 108.30, not moving too fast. Let's look at the calendar here. It's the FX Street calendar on Forex Crunch, where the headline figure to watch is the, no, it's not this one, sorry. It's the business climate. That's sort of the snapshot figure, expected to remain unchanged at 109. But we also have the current assessment for December, also expected to remain unchanged. And the expectations for the future, these are expected to tick a bit higher from 104.7 to 105. Basically, we had a good figure from ZU this week, and perhaps we'll have something a bit better than expected also from IFO. Let's see if it really supports the euro or not. We also have the economic bulletin from the ECB at the same time, but it's already a bit stale because it's 2 weeks after the ECB decision. And we have retail sales in the UK. So this is quite a busy week for the UK. I mean, it's a bit under the radar because of the Fed, but still of importance. So retail sales are expected to show an annual rise of 3%, weaker than 3.8 last time. Although basically this is a nice growth. Month over month, 0.5%. All right. Yeah, there's also core retail sales, but it's not that important in the UK. In the US session, of course, we have let me add this here because it isn't insignificant. That's 6:45 in. Let's see if I have the. I think it, no, sorry, I confused you beforehand. It's 11:45 GMT, which is 6:45 a.m. in the United States. Yeah. Okay. So we have the first test of the implementation of the rate hike. I think it'll be smooth and will not move markets, but just take a look at the watch at this time if you're trading. 11:45 GMT. At 1:30 we have the usual weekly jobless claims from the United States. Let's see if we're getting closer to full employment also here. Last time it disappointed with the rise to 282,000, but you can see the general trend is a falling jobless claims. More jobs, this time a small dip is expected to 275,000. And we'll have another look at the manufacturing sector with the very early figure from the Philly Fed Manufacturing Index. Last time it managed to rise back to positive territory to plus 1.9, but never went fast at all. This time it's expected to rise drop to 1.5. I think echoes from the Fed, more analysis, more reactions, the implementation, even though are expected to move markets a bit more. If the European session is relatively calm, after the Asian session gave a boost to the dollar, now we're seeing it weakening, but very, very gradual, if you wish. In general, the rate decision is strengthening the US dollar. Okay, across the board. And this includes more the majors than the minors. Well, not exactly. I would say the Kiwi is showing some strength. The Aussie is also okay. Canadian dollar falling with oil. Euro sliding, pound sliding, yen sliding. Okay. And at night, the rate decision by the Bank of Japan. No changes expected, and there are no rush to act, of course, with a relatively stable yen and even weakening a bit. Okay, let's see if we have more questions. Okay, thank you for this comment. Here is the full implementation. Let me try to put that on the screen. Let's see how I can put it. Well, I'll put it also on the video so you guys can see that. So thank you very much for this comment. EDZFX, and I'll put it large on the screen from the chat here. Okay. I'll read it out. Found this: the 2.6 trillion park that the Fed is a technical mountain to climb. There are many dark and not so dark corners of the internet that have been predicting the Fed will have a difficult time hiking rates. Here are 5 events to watch in the days ahead that will show whether or not they were right. I believe they were wrong, yeah? But so 6:45 is the first test. I think that if the first test passes, the LIBOR fix here that you put here, 6:45 Eastern time, which is 11:45 GMT. I think the other tests will not be watched that closely, but let's read them out. In any case, 8 a.m. Eastern time, repo rates will begin to update. Repurchasing 9:30 in Eastern time. That's 2:30 GMT. Rates on commercial papers trade. Then the New York Fed announces the results of its first overnight reverse repo. That's what they do, by the way. Every day I'm following their RSS feed, and it's always 0.12, 0.13. This time it's expected to be somewhere around 0.37. But if it's around 0.32, I mean a bit lower, but just, I mean, a bit, not close to 0.25, then it's okay. It's just the first time. I wouldn't worry too much. And at 8 a.m. Eastern time on Friday, that means 1 GMT, the first post-hike Fed funds effective rate is announced. So I would say that the next 24, 28 hours is when the implementation will be tested, but I would not say that it is. I don't think they'll have problems with implementation because they've worked on it for so long that I believe it should be okay. Okay. Let's see more questions and put more charts. Let me take this thing out of the chat box, put it in somewhere else. And let's see what other questions you have here. So thank you very much for that. EDZFX. Jay asks, how about your sales results? As forecast or even better, can make the pound gain stronger. Yeah, basically, I think it's a neutral event. That means that if we have good figures, it's good for the pound. Bad figures, bad for the pound. Very, very straightforward. Is we've seen good reactions. I mean, normal reactions to these figures in the past. Okay. And the question from Fabian. Well, good morning, Sinatra. What do you think about the problem that long dollar trade is still very crowded? According to the most recent CFTC commitment of traders, only a handful of traders cut their short euro-dollar positions after the 5-cent spike in the euro corresponding slide in the dollar. The market is still heavily long US dollars against the euro. Do you expect position closing year-end to return to 110? Well, I expect the US dollar actually to strengthen a bit more towards year-end, okay? And then perhaps when we'll have a bit more certainty, then perhaps we'll have the US dollar slide. The trade is crowded, yes. Everybody's talking about that for months, but it's still of importance. I mean, the fact that rates are rising in the United States is still supportive of the US dollar. A hike is a hike, and especially against the euro where they're cutting rates. So, of course, a lot depends on expectations. But now I think expectations are a bit stronger in the United States. And, well, it's too early to make predictions for 2016, but eventually the dollar will slide on the after the fact when things will become more certain. But at the moment, I see a stronger dollar. I see a comment here about pullback. I need to see a pullback in the pairs. Yeah, of course, Forex is never a one-way street. Here we have the CME Group Fed Watch for which is the implied probability according to bond markets for the future rates. So this is the one for January, and 90% for rates to remain unchanged at a maximum of 0.50. And in March, it's an open game here. We have 51.9 no hike, and well, around 48 for higher rates. Okay, so this is the every meeting with the press conference on March 16th is the potential next rate hike. What could we see then? Well, it depends on how we'll see the NFPs, the general economy, how emerging markets will understand, will accept, will react to this rate hike, and things like that. In general, I believe. Well, sorry, it's a bit too early to assess how things will go. I believe they will raise rates less than 4 times next year, but everything, as they said, is data dependent. Once they slow down a bit more, then the dollar could fall maybe, but too early to speculate about that. Anyway, here we are in euro dollar, awaiting the IFO figure. Let's see more questions, more comments. Up to what support do you expect the rate hike to have its effects on euro dollar fall? I'll just point out the lines that I see on euro dollar, 108.30, which is current support, was a good separator of ranges, and then 107.60, then 106.30, and then the March low, which was also tested on the ECB of 105.30, and then 104.60 to the top side. We have 109.50, 110, 110.70. Okay, so textbooks say currency rate is positive for the currency. So gold forced down to 850 area. So what I'm waiting for a while now. 850 is quite far out. Okay, at some point again, there's real world demand for gold, right? So that's why I think that we won't reach 850, but perhaps a dip under 1,000. But there's less speculation, less hot air into gold. Okay. Mauricio says, however, if the hike is widely expected and the US dollar rose a lot before, it is complicated for the USD to go further against the euro, for example. Yeah, and honestly, I don't see dollar be the king in 2016. I also don't see it. I see it strengthening maybe just a bit and eventually changing course. And again, I think against euro dollar, it might end. I think that euro dollar will end the year higher than what it opens in 2016. But it's never a one-way street. I see it, euro dollar weakening before re-strengthening. But again, a lot depends on the data. Still lots of problems in the old continent. On the other hand, we have growth there. In the United States, we'll have to see how this rate hike impacts the economy, how politics impact the US dollar, as we're less than a year towards the presidential elections in the United States. These election campaigns last basically forever. So many factors to watch. How will oil impact? So far, oil has been a positive for the US economy, but we don't know how it's going to evolve looking forward. Okay, so we have oil leaving more money in the pockets of consumers, but hurting the US oil industry, drilling and junk bonds and things like that. So it's a bit. Yeah, I agree that dollar will not be king in 2016, but how it will end the year is a bit far look at shorter terms. Okay, but anyway, if you want to hear about 2016, it's a good opportunity to promote. Tomorrow, FX Street has an excellent panel about 2016 with some of the brightest heads in Forex. Boris Schlossberg, Adam Button, Ashraf Laidi, Valeria Bednarek, and Dale Pinkert is the moderator. So I recommend we have recommendations for that all over, and can hear more opinions about 2016. Okay. Oh, and Mauricio just put it on the chat. So thanks, Mauricio. Another comment here: stronger US dollar also hurts those who have borrowings in US dollar. Exactly. That's what the IMF has been warning about emerging markets, that because money was cheap for too long, they just took loans in the US dollar and the US dollar was weak, and now they're paying a price. They already feel some of the pain. So far, the world hasn't collapsed, okay? Because they feel some of the pain because of stronger dollar, stronger yields, and now they'll feel more. The IMF is really scared about it. Let's see if it's a real scare or not. I don't have a clear idea about that. Feel central banks help lower gold to buy and replace gold that they sold over the years, that they lie about what amount of vault gold they have. UK Bank of England, they have the Queen, first in history taken down to vaults to say she sells the gold. Yeah, it's is the gold there or not? Yeah. But I think, yeah, France still owes Germany 420 tons of gold that they don't have. Well, we don't exactly know what they have and don't have. And what I can say is that gold is less in demand than it used to be in 2011. Again, there's still real world demand, but not the speculation, and we're not in the gold standard of the 1920s. Okay, so I think we talked a lot already, and I'm very, very grateful for your questions. I hope I covered the Fed from all the angles. Let's get to the wrap up for today. So this is the wrap up for the live market open on December 17th. It's Thursday, and most importantly, the day after the Fed. We have, I hope, no hangover because things went relatively smooth. So we had an historic rate hike in the United States. Rates are now 0.25 to 0.5. That was widely expected, or as Janet Yellen said, not unanticipated. More figures. We had the dot plot, future path of rate hikes. That was left unchanged, which was relatively hawkish. Good for the US dollar, remained at 1.4 for 2016 and 3.5 in the long term. Forecasts were basically balanced, not surprising. I think it was, she talked about confidence about the US economy. We also had confidence that the Fed is united, no dissenters. Okay, that also helped. The US dollar strengthened, then immediately retreated, but eventually markets bought the US dollar, especially in the Asian session. Yellen said they want to begin the process now, not to raise rates abruptly. Low inflation is transitory. US dollar is impacting core inflation, that's transitory. Oil prices are impacting headline inflation, that's transitory. No worries. And they don't need to see inflation reach 2% before moving again, because they did put an emphasis on inflation in general. She said monetary policy is still loose. We're still supporting the US economy. Stock markets rallied. That means it was very well received. And the US dollar is gaining strength, but nothing earth shattering. We're not seeing any sky falling. Okay, in other news, we had UK wages disappoint, and that's why the pound is vulnerable. Inflation in the Eurozone basically not exciting. Good figures from the United States on housing that might have an impact later on, but it was ignored yesterday because of the Fed. And oil prices remain on the downside yesterday. The recent blow came from inventories. There's just too much oil sloshing around, and that hurts currencies. Today we have on the agenda, just after the show, the German IFO figure, number one think tank in Germany. No changes are expected. Let's see if it moves the euro. At 9:30 UK retail sales, this usually has a strong impact on the pound. Then we have a series of implementation tests for the Fed regarding the rate hike. The first one is at 11:45 GMT with the LIBOR fix. I think that if this goes well, the other tests, which of course are important, will be sort of looked a bit. The markets will not look at them that closely. I think the Fed has made all the preparations during 2 years for this move. They made lots of exercises, trained their staff, reverse purchasing. I think it should go well. We have jobless claims at 1:30 in the Philly Fed Index. No big changes are expected there. Of course, jobless claims is the weekly barometer. And at night we have Japan's rate decision. No changes expected there. I'm sure that the guys in Tokyo are a bit happy to see dollar yen a bit stronger today. Let's talk about currencies. Euro dollar dropped to lower ground, stronger US dollar across the board. 108.30 support, further support 107.60, 106.30, resistance 109.50, 110, and 170. Pound dollar a bit more vulnerable, 149.32, getting closer to the lows of 149, 148 further support, 150 is resistance. Dollar yen made the break back above the 122.20 level, which we talked about many times as a separator of ranges. Look how it settles nicely above this level. Still not going higher, but this line is a clear separator. Further resistance 123.60, support 121.10. Dollar CAD, the sky is the limit. We're not at the recent sky, we're a bit off the highs, but above 138. Basically, dollar CAD unstoppable after breaking 134.60 with the collapse of oil prices. Okay, I see resistance only at 140 just because it's a round number. Support at 136.20. Let's see where oil prices go. The Canadian dollar is weak. Aussie dollar, excellent technical behavior, wide range between 70 to 80, which worked superbly in recent weeks, and 71.60, I would say. 72.20 serves the pivotal line in the range. Kiwi dollar sort of standing out with relative strength, so it didn't manage to push higher, but it's holding on to higher ground at 67. We had something I forgot to mention. We had GDP in New Zealand. It came out a bit better than expected, but with a small downwards revision. All in all, a-okay, no big shocks. Dollar Swiss, stronger dollar, seen also here getting closer to parity. But remember, dollar Swiss moves in tandem with euro dollar. Euro Swiss is almost always in the 108 handle every morning in the show. Support 107.60, resistance at 108.40 perhaps. But I don't like it because of high intervention. Okay, we covered quite a lot. Let's see if we have some final questions before heading off. So you have here the link for the panel for tomorrow. It should be very interesting. Question from Fabian: any neutral IFO figures going to strengthen the euro or weaken it? No, neutral means, I think, neutral. If we have a big fall to 108 instead of 1.109, then I believe we'll have weaker euro, and closer to 110 will strengthen it. But the Fed has, IFO is an important figure. It's the #1 think tank in Germany. Okay, but everything comes in context. We're less than 24 hours after the Fed, so the Fed, and the Fed move markets. Okay, so that's why it's an important figure, but for today, it should have a relatively small effect. Important to watch, but not critical. Okay, pairs to watch today. As always, Jax. Well, in general, the US dollar is still in focus. Okay, pound dollar for the morning, because retail sales, I believe, will have more impact than IFO, and later on for the best reaction to the implementation, perhaps dollar yen. But in general, it's still all about the dollar today, with the echoes of the Fed hikes. So I would look more to majors, pound dollar, euro dollar, dollar yen, and of course we have the ongoing story with oil. But today it's not the most important day for oil, because yesterday we had inventories and things like that. Okay, so it's quite a busy show for today, for the day after, the morning after. So thank you very much, everybody, for coming. Thank you for the great questions, the great help on the details, on the implementation. I'm very grateful for everything. And of course, we'll be here tomorrow. Let's see if the dollar continues strengthening or perhaps settles or reverses. We had a very historic decision yesterday. All right, so thank you very much. Safe and successful trading day to all, and see you tomorrow. Bye bye.